My name is Bruce Jorgensen. Today I'd like to explain briefly what retained earnings are and how they come about. The accounting definition of retained earnings is that it's accumulated profits, money that's kept in the business after the end of each year that you decide to invest in future operations rather than pay it out as dividends or other distributions. Here's a simple balance sheet that reflects four basic accounts, some cash, accounts receivable, no liabilities, stockholders' equity consisting of capital that you originally put into the business, your seed money, plus any earnings, any profits that you've kept in the business to continue on in the future. That's what we call retained earnings. Now you'll notice in this simple example that the cash account is dramatically less than what's showing in the retained earnings account. You may wonder how that can be. Hopefully, after you watch this short presentation, you'll be able to answer that question. In accounting, we use a system called double entry, and that basically means that for every transaction, there are two sides to it, a debit side and a credit side. I'm using this simple T account description to show you how transactions are handled, and I think it'll help clarify what happens to retained earnings. So, for example, when you first start a business, you put some money into the business, you open up a bank account. Where did that money come from? Well, we call it capital. Others call it seed money. But basically, what you see here from this T account analysis is I've got cash on the left and I got capital on the right. You add the two up, or rather you subtract one from the other, and it equals zero. Or as we'll show in a few minutes, we display both numbers, but we put them in different categories to help you understand how your business is structured and where the ownership lies. Let's continue with this simple example. After your first year of operation, you've spent some money on expenses, in this case $125,000, and we try to show where we spent it from. Well, we're making the assumption it came from cash, and the same amount, $125,000. So everything is still in balance. We could just as easily have spent it with a credit card, but for most purposes, credit cards and cash are equivalent. The assumption is you pay off your credit card every month. Not always, but that's the assumption we're going to operate with here. We also had sales, and we recorded the sales on the right-hand side of our T account, and then what's the offset? Well, if you're a cash business, you'd put it into the cash account. But we're not. We're a hustling sales organization, and we always give our clients terms. And so for the first year, we've accumulated a total of $150,000 in accounts receivable, meaning all the sales we made in the first year have to be put on to an account that's not cash, because we haven't collected it yet, but we expect to. That's what we call accounts receivable. At the end of the first year, then, we prepare a financial statement that looks something like this. We show the balance in our cash account, which is the $200 minus $125,000, or $75,000. We have accounts receivable now of $150,000, and that adds up to a total of $225,000. On the other side of the coin, we contributed originally $200,000. Our beginning retained earnings account is zero, but a part of retained earnings is the accumulated earnings or accumulated profits. In this case, the first year's operation was $25,000. That's sales minus expenses. When you add up capital and retained earnings, lo and behold, it equals our cash and accounts receivable. That's by design. That's on purpose. When they don't equal each other, we have a problem. And that's where accountants kind of get excited and dig into it and try to figure out what went wrong that it would report total assets different than the total liabilities and owner's equity. But that's a story for another day. Now we're going to close these accounts out, and we report transactions to reduce the sales account back to zero, and we reduce the expense account back down to zero. Because these accounts, we only keep them around for the current year. Now, what do we do with that offset? We got $150,000 minus $125,000. And that's where retained earnings come into play. We put it into this account called retained earnings, and everything still balances. And we look at our new financial statement after we closed, and we show basically the same information we had before, but instead of showing current year profit, we just have our beginning balance for the new year. So we're still in balance. Everybody's happy. The accountants particularly are happy, very pleased with themselves. The rest of us may be scratching our heads because you're saying, well, gosh, I've only got $75,000 in cash, but I only have $25,000 in retained earnings. So if I wanted to, I could pay a dividend out from my retained earnings account and I'd still have some cash around. Well, let me show you what's going to happen next in our second year. Basically, the first thing we do is we show the transaction that happened during the year. In this case, we collected all of our accounts receivable. That's a big thumbs up. And then we had an additional $300,000 in sales, so that increases accounts receivable. And you can see that our sales and expenses, fortunately, we had more sales than we had expenses, so our financial statement looks something like this. We have cash of $75,000, accounts receivable $300,000, so our total assets are now $375,000. Still the same amount of contributed capital. Our carryover from the prior year's retained earnings mean we start with $25,000 and our current year income is $150,000. So now our total liabilities and owner equity is $375,000. We're still in balance and we're still happy. But notice that cash is only $75,000 and our total retained earnings account, the beginning balance plus current year income, is $175,000. And that raises some interesting questions. Where did that 175 come from? Starts off with a year one profits. Didn't have any distributions in the year one, so our balance was 25,000. We had year two profits of 100,000. No year two distributions, so our ending retained earnings balance is 125,000. But we remember we only had $75,000 in cash. So the questions might be, well, how can the company pay stockholder dividends if the retained earnings is less than cash? Yeah, that's a good question. One possibility is you have to limit your distributions to how much cash you have. And probably you don't want to do that because you need cash to operate your business. So you may have to pay much less in dividends than you have in retained earnings. That's not against the rules. Now, I gave you a very simple example of what happens to cause retained earnings to be different than cash. There are many other types of transactions, most of them having to do with choices the management of your company may make to invest in the future. Perhaps you need to buy some equipment, or maybe you want to be real aggressive about spending on advertising and promotion, and you've made a special deal where you don't have to pay for it, and you don't have to use a credit card. They agree to allow you to put your advertising on account. And so now your accounts payable go up. You didn't have to spend any cash, but your accounts payable went up, which would still reduce how much you have in net earnings at the end of the year. And again, what are the consequences to the stockholders if dividends are paid? Now, depending on whether you're a C Corp or an S Corp, the answer is different. If you're an S Corp, there are no taxes on dividends because you have to report income from your S Corp when it's earned. In other words, each year. Now, if you're a C Corp, on the other hand, you don't pay tax at the individual level on the income of the business, but you do pay tax on any dividends received. And also in a C Corp, the net income each year is taxed currently at 21% in the United States, plus any state income taxes. So a lot of people say, well, the S Corp sounds attractive if I can stand to report income as it's earned rather than when I get some of that because I'll pay less total tax. But there is a problem with S Corps. Dividends from an S Corp are subject to special attention by the IRS. There's some rules related to reasonable compensation that you have to abide by, or you'll be subject to penalties and interest on unpaid payroll taxes, unpaid income taxes when you didn't choose to report enough owner salaries. That's a topic for another day. We won't get into that now, but basically, any corporation has a retained earnings account. And for that matter, all businesses have retained earnings. It's just a function of when you get taxed on them. So I hope that helps you understand a little bit what retained earnings are. Thanks a lot.